An employment number that's strong, but not too strong, was just what this crazy market needed today. Although it took half the day for Wall Street to figure that out. Dow going down at first, but then eventually finishing up 572 points. S&P gaining 1.95%. NASDAQ advancing 1.55%. It was a hidden Goldilocks report, let's call it that. A lot more people are getting hired thanks to the vaccine rollout in the opening. But not so many that the Fed will feel compelled to raise interest rates, and some are really being left behind. Why does that matter? Because the bond market is calling the tune right now, and when the bond market's pleased, meaning Treasury yields are stable, as they ended up today, or even go lower, didn't get that, buyers rush into the stock market because they know the competition from bonds will remain benign. A benign bond market serves as an all-clear signal for the stock market bulls. Now, this has been a confusing time for fixed-income investors because the whole narrative on the economy changed practically overnight. We went from a period of stagnation, where we were propped up by government spending, to the beginning of what could be a potential boom as more people get vaccinated and Washington gets ready to throw more fuel on the fire. If the economy is poised to get so much better, why the heck do we need the Federal Reserve to keep giving us easy money, right? Interesting question. And that is the bond, what we call the bond vigilantes position. They want rate hikes. They think the economy's too hot. I get that. However, Fed Chief Jay Powell insisted he won't tighten anytime soon because so many people are being left out of potential comeback. The inflation is really just nascent and could go back down. And even though he's been very right on the economy so far, the bond vigilantes have decided he's just some dove in a suit who's going to create a tsunami of inflation with his stance. I think they're wrong. I think Jay Powell's right, but I'm not the one who controls the bond market. I keep telling you this moment feels like the period from November 2015 to February 2016, when our old Fed chief, Janet Yellen, looked at the dashboard of the economy, very similar to right now, saw some inflation indicators flashing red like we have right now, and decided it was time to raise rates, even though she appeased the bond vigilantes and gave a sample warning. The economy was crushed and stocks took a hit. And that's what I fear. I fear a repeat of that time. And I am staying not as a vigilante, but I'm staying vigilant. Powell refuses to be cowed, but the bond bullies, who are very powerful, don't believe it. The Fed's had a zero-tolerance policy toward inflation for my whole career. These guys can't imagine suddenly there's this guy Powell who would chart a new course no matter how many times he explains it. Now, the session opened rocky because lots of investors bought stocks with borrowed money over the last few weeks, margins nearing a record high here, and they got blown out by this week's decline and a sharp initial move up in rates in reaction to that employment number. But then rates reversed, and we got one of those whoosh bottoms I've been telling you about, where we have a sharp decline fueled by forced selling, and then the market swiftly rebounds when that selling is over, if the bonds rally and interest rates fall, and that's what happened. So are we out of the woods? No, that's just one day's worth of a scenario. Not so fast. The battle is far from over, with lots more collateral damage, particularly, by the way, I don't know if you noticed, but the highest growth stocks, even today, and the myriad SPACs, they're still being taken out and shot despite the nice backdrop. Basically, everything that was red hot a month or two ago is not so great. So here's how I see it playing out. Whenever we get good news for the economy, like when the Senate passes the stimulus package, or when we get big vaccine benchmarks, the bond vigilantes will come out of the woodwork with the same playbook that you saw early this week. They will dump bonds, pushing long-term interest rates higher and triggering more weakness in the stock market like we saw yesterday. The only thing that will stop the bond bullies is weaker economic data, especially lower commodity prices like oil, copper, lumber, plastic, and paper. That hasn't happened yet, but if you got those lower, then the heat's off Powell.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.